Welcome to the GCV Weekly Briefing podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. This week, we'll be diving into four major stories, from rising activity in the UK housing market to record levels of cash ISA inflows, fresh tax reform signals, and mounting pressure on manufacturers. I'm Matthew, and here's what you need to know. First, let's start with the housing market, which continues to show a surprising degree of resilience, even in face of policy uncertainty and ongoing economic pressures. Nationwide's latest house price index, published on Monday, showed a 0.5% rise in the average UK house prices in May, reversing the April 0.6% decline. That puts the average home price now at £273,000. According to Robert Gardiner, Nationwide's chief economist, completions among owner-occupiers have now hit their highest level since mid-2021. Mortgage approvals have also been holding quite steady, supported by low unemployment, improving wages, and growing expectation of the Bank of England rate cuts later this year. Interestingly, the shift towards rural living is still in play. Since 2019, rural house prices have climbed by 23%, compared to 18% in urban areas. The data suggests that this trend is driven largely by older buyers, while younger movers still prefer towns and cities. In fact, 9% of moves last year were from urban to rural locations, compared to 7% the other way around. But volatility still does remain. Alice Hayne, a personal finance analyst at Best Invest, pointed out that while recent rate cuts, 4 since last August, have helped ease mortgage terms, inflation and global pressures continue to cloud the outlook. She also highlighted that around 500,000 homeowners are expected to see their fixed-rate mortgages expire this year, meaning that many will face significantly higher repayments as a result, pushing some to act sooner rather than later. In her words, uncertainty is becoming the new normal, and for many buyers, it's better to move ahead than wait for perfect conditions. Turning now to personal finance, April saw a record-breaking $14 billion poured into cash ISAs, the highest monthly total since the product was introduced back in 1999. According to the Bank of England data, much of this appears to be driven not just by interest rates, but by concern that the government may cut the annual cash ISA allowance. Savers seem to be moving early to secure their tax benefits. Most savers say that they wouldn't move their money into stocks if ISA limits were cut, and only 1 in 5 would redirect savings into the stock market. This is a problem for the Treasury, which has floated ISA reform as a way to build stronger investment culture. Critics argue the approach may backfire. AJ Bell, for example, points out that simplifying the ISA system could be more effective than forcing savers into equities by reducing allowances. Their recent behavioural study shows that savers have a strong preference for certainty, and for many, guaranteed interest feels safer than the ups and downs of the markets. As the AJ Bell commentary put it, encouraging more people to invest for the long term is laudable, but cutting the cash ISA allowance just won't do it. With capital gains tax, dividends tax, and even inheritance tax under ongoing review, savers are rightly wary. And in this environment, ISAs, along with other products like the EIS and the SEIS, remain one of the few consistent ways to plan tax efficiently. Now, on to manufacturing, where rising industrial energy costs are starting to draw a real concern. Make UK, the voice of British manufacturers, reports that UK industrial energy prices are now 46% higher than the global average. They argue that this is hurting competitiveness and deterring investment, particularly in sectors like steel and chemicals. One issue is how energy bills are structured. Right now, policy costs are stacked heavily onto electricity, which makes low-carbon technology like heat pumps more expensive than fossil fuel alternatives. Energy UK says this setup is undermining the shift to greener energy. So what's Make UK's proposed fix? Well, it's a state-backed pricing mechanism. Under the plan, manufacturers would receive government top-ups if energy prices spike, and repay the difference when prices fall. This could help stabilise costs and provide certainty for long-term planning. Stephen Phipson, CEO of Make UK, didn't mince words. He said, "If we do not address the issue of high industrial energy costs in the UK as a priority, we risk the security of our country." The government's response has focused on its £5 billion British Industry Supercharger scheme, aimed at easing the bills for energy-intensive sectors. but broader reform is still being looked at, including rebalancing gas and electricity pricing, though ministers say any changes will be carefully weighted against consumer impact. Finally, there are growing signs the Chancellor may target employee benefits in autumn, particularly salary sacrifice schemes and benefits in kind. Together, these benefits represent a large chunk of tax relief. In the 2023/2024 year alone, pensions offered $23.5 billion in national insurance relief and $28.5 billion in income tax relief. Recent surveys from HMRC modelled different reform scenarios, including a full withdrawal of reliefs or caps on tax exemptions. The most manageable option so far being explored is a £2,000 cap on NIC relief. While not a major overhaul, it would still affect many employees and employers. Another survey looked at BIKs, things like company cars, workplace parking, and cycle-to-work schemes. These perks are more common in larger firms and are often aligned with green targets. About 26% of them are offered through salary sacrifice. Cutting these benefits, even modestly, could discourage employees and undermine financial planning. Carolyn Harwood at BDO made the point clearly, saying these changes would still be unpopular, especially for workers who use salary sacrifice to lease electric vehicles or build pension pots. And while the government may be under pressure to reduce the cost of these schemes, it'll need to balance that with the impact on employers already facing higher payroll taxes and rising wage bills. From volatility in the financial markets to uncertainty in the housing sectors, today's economic and investment landscape is undeniably unpredictable. With potential reforms to key tax-efficient products like ISAs and the continued rise of both direct and indirect taxation, investors face an increasingly complex environment. In times like these, portfolio diversification remains more important than ever, a vital strategy for offsetting risk and navigating market turbulence with greater resilience. Through spreading investment exposure, balancing saving and investing, or leveraging tax-efficient schemes such as the EIS and SEIS, diversification will offer some of the most effective ways to adapt with confidence. As the rules shift and investor behaviour evolves in real time, long-term resilience will come not from chasing certainty, but by building portfolios that are built to withstand the unpredictable. That's all for today. Thank you for listening.